During today's presentation, we will discuss advanced topics pertaining to FDIC deposit insurance coverage. While prior participation in one of our seminars titled Fundamentals of Deposit Insurance Coverage Seminars is not a prerequisite, we will be building upon topics discussed during that seminar. As a quick overview of what we will cover, today's presentation is divided into 9 parts, as described on this slide. Part 1, General Principles of Deposit Insurance. As a quick refresher from our 2016 Fundamentals of Deposit Insurance Coverage seminar, in order to determine deposit insurance coverage, it is critical to ask and answer the following 3 questions. First, who owns the funds? Second, what ownership category is the depositor eligible to use or attempting to use? And finally, does the depositor meet the requirements of that category? FDIC regulations provide for up to 9 different primary categories of deposit insurance coverage, and therefore this means up to 9 different ways to get separate deposit insurance coverage. For today's presentation, I will be discussing the 3 categories on the right side of this slide. Category 7, Business Organization Accounts, Category 8, Government Accounts, and Category 9, Principal and Interest Funds in Mortgage Servicing Accounts. The ownership categories for individuals, which you see on the left side of the slide, are addressed in our Fundamentals of Deposit Insurance seminar. In addition to reviewing the 3 ownership categories in parts 2 through 4, in parts 5 through 8, we will focus on other topics which impact deposit insurance coverage. Part 2, Business Organization Accounts. Under the FDIC regulations, there is only one ownership category which applies to business organizations. Category 7, Business Organizations, includes corporations, including Subchapter S, LLCs, and professional corporations. Also included are legally created partnership entities and unincorporated associations. Please note that the business or organization must be engaged in an independent activity. This means the business entity must have been formed for a business purpose and was not created for the sole reason of increasing FDIC deposit insurance coverage. Typically, the existence of separate business entities is supported by organizations with separate tax identification numbers and a separate charter or bylaws. But please note, corporations will sometimes obtain separate tax identification numbers for different divisions within the same corporate entity. This would not provide for separate deposit insurance coverage. Coverage for business organizations is up to $250,000 per legal entity engaged in an independent activity. It is important to note that the existence of multiple signers does not increase coverage. Also, a separate business purpose for funds owned by the same legal entity does not increase or create separate coverage. Part 3, Government Accounts. Our 8th ownership category is titled Government Accounts, or sometimes they are referred to as Public Unit Accounts. As with business entities, there is only one category that applies to government accounts. So what is a government account? A government account is a deposit placed by an official custodian of a government entity, including federal, state, county, municipality, or political subdivision. Who is considered an official custodian? An official custodian is an appointed or elected official who has plenary authority, including control or decision-making authority over funds in the account owned by the public unit. As shown on this slide, by statute, and as described under the FDIC regulations, the following government entities are specifically covered under this category. Other government entities may qualify for deposit insurance coverage under this category, but the entity must demonstrate they meet the definition provided for under the state law in which they operate. So how does the FDIC insure government accounts? Coverage for this ownership category depends on the type of deposit and the location of the bank. If the public unit is located in the same state as the bank, then the official custodian for the government entity is insured for up to $250,000 for the combined amount of all time and savings accounts, and in addition, up to $250,000 for all demand deposit accounts, including both interest-bearing and non-interest-bearing demand deposit accounts. Please note that in-state coverage includes a branch office of an FDIC-insured bank located in the same state as the government entity. If the public unit is located in a different state than the bank, the official custodian is insured for up to $250,000 for the combined total of all deposit accounts. Please note that multiple signers for a government entity does not mean that each signer qualifies as an official custodian. We have included on this slide a chart on the distinction between NOW account and interest-bearing demand deposit accounts. Many depositors and bankers confuse these two accounts and assume that a NOW account is an interest-bearing demand deposit account. This is a misunderstanding that we encounter since the repeal of Reg Q in 2010, which now permits the payment of interest on demand deposit accounts. Understanding the distinction between interest-bearing demand deposit accounts and NOW accounts is critical for deposit insurance coverage under Category 8 government accounts. For purposes of deposit insurance, NOW accounts are considered savings accounts and will not be classified as interest-bearing demand deposit accounts. Most questions that arise for government accounts concern determining whether different functions of a government entity qualify as separate entities for the purpose of separate FDIC deposit insurance coverage. The determination of whether there are multiple government entities must really be done by the officials for the government entity itself, since there are local or state statutes that describe the creation and the powers of the government entity. If you have questions regarding deposit insurance coverage for government accounts, you see referenced on this slide a link to the FDIC's fact sheet created for bank employees to provide to their government depositors to assist in determining the amount of deposit insurance coverage they may be eligible to receive. Part 4, Mortgage Servicing Accounts. Based on the regulation passed in 2008, the ninth category of deposit insurance coverage pertains to mortgage servicing deposits for principal and interest, or P&I payments. This category concerns accounts established by mortgagees or lenders and represent commingled P&I payments received from borrowers. The rule for Category 9, mortgage servicing accounts, provides that commingled principal and interest payments, or P&I accounts, established by mortgagees or investors are insured with coverage provided up to the SMDIA of $250,000 per borrower. This coverage is provided to mortgagees or lenders as a collective group and is based on the borrower's payment of principal and interest. For Category 9 mortgage servicing accounts, deposit insurance coverage is up to $250,000 per mortgagor or borrower. Funds insured under this category are not added with any other deposits that the borrowers may have at the same bank. In addition, it is important to note that the calculation of deposit insurance coverage for deposits holding the commingled payments of taxes and insurance, or T&I premiums, are different. T&I payments are still insured on a pass-through basis as the single ownership funds of each respective mortgagor. Any T&I funds on deposit in a bank would be added to any other single ownership funds owned by a mortgagor. Let's discuss a quick example on how coverage for mortgage servicing accounts works. Let's assume we have a mortgage servicer or lender who collects from 1,000 different borrowers their monthly mortgage payments of $2,000 for P&I and places the funds into a mortgage servicing account. The mortgage servicer wants to know if the $2 million aggregate balance of the account is insured. The answer is yes. The account is fully insured to the mortgage servicer because each mortgagor's payment of $2,000 of P&I is insured separately for up to $250,000. Part 5, Health Savings Account. A health savings account, or HSA, is a tax-exempt trust or custodial account that you set up with a qualified HSA trustee, such as an FDIC-insured bank, to pay or reimburse certain medical expenses you incur. HSAs, like other deposit accounts, are insured based on who owns the funds and whether beneficiaries are named in the bank account records. So if a depositor opens an HSA with no beneficiaries named, then the FDIC would insure these funds under Category 1 single ownership accounts. But more often, we find that depositors establishing HSAs name beneficiaries on these accounts in the bank records, similar to a payable on death account. Therefore, when beneficiaries are named, the FDIC will insure an HSA deposit under Category 3 revocable trust accounts and insure the owner in the same manner as a payable on death account. The FDIC does not require POD or ITF to be inserted into the account title. The identification of the account as an HSA, such as John Smith's HSA, and the listing of beneficiaries in the deposit account records are sufficient for titling the account to be eligible for Category 3 revocable trust coverage. Part 6, Pass-Through Deposit Insurance Coverage. We will now move our discussion into a complex area, pass-through deposit insurance coverage. The FDIC rules for pass-through coverage can be found at 12 CFR Section 330.5 and 330.7. Let me start by explaining that a fiduciary or agency account is not a separate category of deposit insurance coverage. A fiduciary or agency account is a deposit established by a third party for the benefit of the actual owner of the funds. So what makes these deposits different? An account that meets the definition of a fiduciary or agency account is entitled to what the FDIC regulations describe as pass-through deposit insurance coverage. What we mean is that the deposit insurance coverage will pass from the FDIC through the third party who establishes the account to the actual owner or owners of the funds. Therefore, depending on the ownership of the funds, a fiduciary or agency account may be covered under any one of the 9 deposit insurance ownership categories. Some common examples of third parties who may establish a fiduciary or agency account include an agent, nominee, guardian, conservator, executor, or broker. Common examples of the types of accounts these third parties may establish include escrow accounts, an account with a power of attorney designation, accounts under the Uniform Transfer to Minors Act, or UTMA, attorney trust accounts, or IOLTAs, agency accounts, and brokered CDs. What is pass-through deposit insurance coverage? When funds are deposited by a fiduciary or custodian on behalf of one or more actual owners of the funds, the FDIC will insure the funds as if the actual owner had established the deposit in the bank themselves. What is the amount of pass-through deposit insurance coverage? Assuming the deposit meets the requirements for pass-through insurance coverage, then the amount of FDIC insurance coverage will be based on the ownership capacity in which each principal owner holds the funds. Let's look at some examples of banks' involvement with agency accounts. A bank may accept or receive third-party deposits in a number of ways, including 1. As a direct depository for agency funds. For example, a third-party agent deposits the funds directly with the bank on behalf of the principal owner or owners. This is the most common situation where fiduciary or agency accounts are established. 2. As an agent broker placing funds with other banks as part of a third-party program. And 3. As an agent broker placing customer funds with other banks as part of the broker's own deposit placing program. As we have discussed, an account is not entitled to pass-through deposit insurance coverage unless certain requirements are met. These requirements include the funds must be owned by the principal, not the third party who set up the account. To confirm the actual ownership of the deposit funds, the FDIC may, first, look to the legal or contractual agreement between the third party establishing the account and the principal. And second, look to state law to determine who is considered the owner of the funds. It is essential that the bank account records indicate the agency nature of the account. This can be done by using an acronym or language in the title that clearly identifies that an agency relationship exists. For example, accounts with a title such as XYZ Company as custodian or XYZ FBO, meaning for the benefit of others, or an account set up for a minor titled Jane Doe UTMA John Smith Jr. would all be acceptable. It is also essential that either the bank records or the account holder's records indicate both the principal's identities as well as their ownership interest in the deposit. Typically, it is a third party who establishes the fiduciary or agency account and who maintains the specific information about the principal owners and their ownership interest outside the bank records. It is also important that the deposit terms, that is, the interest rate and the maturity date, for accounts opened at the bank match the terms the third-party agent promised to the depositor. If they don't match, then the third-party agent might be deemed to be the legal owner of the funds. It is acceptable for an agent to retain a portion of the interest as the agent's fee without precluding pass-through deposit insurance coverage. What does the FDIC check for when a bank fails? Was the custodial account open in the name of the owner? For example, ABC Inc. for the benefit of John Smith? Were the funds held in a commingled account? And does the bank have information concerning the name and ownership interest of each depositor? For example, payroll account cards? Were the funds held in a commingled account and the custodian is maintaining information regarding each owner? For example, broker deposits, IOLTAs, third-party stored value cards? Or do the terms, that is, interest rate and maturity date, match the terms promised by the fiduciary or agent? For more information on pass-through deposit insurance coverage linked to deposits opened by affiliates, please see Financial Institution Letter 29-2010 titled Guidance on Deposit Placement and Collection Activities, issued on June 7, 2010, and available on the FDIC's website. Part 7. When banks merge. What is the insurance coverage when a depositor has accounts in two banks that merge? Well, when two banks merge, the accounts are insured as if the banks were still separate legal entities for 6 months. Now, there is a special exception for time deposits, such as certificates of deposits. Time deposits that were issued by the former bank are insured for the greater of either 6 months or the first maturity date of the time deposit. This topic can be a bit tricky, so you may want to review these slides again after our presentation. Let's look at an example that explores the merger of banks involving CDs. We will refer to our two banks in this example as acquiring bank and bank sold. So to begin, acquiring bank and bank sold merged on July 1st, 2010. Before the merger, our depositor, Michelle Young, had purchased the following. 1. A $240,000 CD from acquiring bank on January 1st, 2009. The CD has a 4-year term and it matures on January 1st, 2013. And 2. A $230,000 CD from bank sold Purchased on October 1st, 2009. The CD has a 1-year term, and it matures on October 1st, 2010. 3 months after the merger, on October 1st, 2010, Ms. Young renewed her bank-sold CD for another 1-year term until October 1st, 2011. Ms. Young rolled over her original $230,000 principal. Assume accrued interest is mailed monthly for both CDs. So the question is, how are these CDs insured? Let's begin by looking at Michelle's accounts and the merger. Before the merger, Michelle Young purchased a $240,000 CD from Acquiring Bank on January 1st, 2009. The CD has a 4-year term and it matures on January 1st, 2013. On the slide, this CD is represented in purple. Michelle also purchased a $230,000 CD from Bank Sold on October 1st, 2009. The CD has a 1-year term and it matures on October 1st, 2010. This CD is represented in yellow on the slide. At the time of the merger, Ms. Young has a $240,000 CD from Acquiring Bank and a $230,000 CD from Bank Sold. As we can see on this slide, Acquiring Bank and Bank Sold merged on July 1, 2010. This is represented by a vertical bold line in black. As we have discussed, when two banks merge, the FDIC regulations provide for a 6-month grace period. In this case, the 6-month grace period extends to December 31st, 2010. This grace period is represented by the striped box on this slide. As you will see on this slide, during the 6-month grace period, Michelle renews her bank-sold CD with the same terms, so her two CDs continue to be insured separately until her bank-sold CD matures on October 1st, 2011. Remember, under FDIC rules, CDs that mature during the 6-month grace period and are renewed for the same term and in the same dollar amount, either with or without accrued interest, continue to be separately insured until the first maturity date after the 6-month period. On this slide, the renewed CD for $230,000 is represented in blue. Because of the FDIC 6-month rule, both deposits continue to be separately insured as if Bank Sold still existed, holding a deposit for $240,000 and a separate deposit at Acquiring Bank for $230,000. As we discussed on the previous slide, Michelle's combined deposit of $470,000 is fully insured until October 1st, 2011. However, once her bank-sold CD matures on October 1st, 2011, there is a potential for uninsured funds. After October 1st, 2011, the deposits will not be separately insured. Of the $470,000 in funds, $250,000 will be insured and $220,000 will be uninsured. To avoid potentially uninsured funds, Ms. Young must either withdraw at least $220,000 or look to see if it makes sense to restructure a portion of her funds in another ownership category. Part 8, Right of Offset. When a bank fails and the depositor has uninsured funds, it may be possible to offset the uninsured portion of the deposit if the depositor also has an outstanding loan with the failed bank. The requirements to voluntarily offset the funds are: 1. There must be mutuality. That is, the owner of the deposit and the borrower on the loan must be the exact same party. 2. The deposit cannot be a special purpose deposit. For example, funds that are being specifically held by the bank trust department for safekeeping. 3. The deposit is not the property of a third party. And 4. The offset is permitted by state law. Part 9, Deposit Insurance Resources. In addition to today's presentation, the FDIC is offering 2 other seminars which cover a wide variety of topics. As you will see on the left side of this slide, in 2016, the FDIC will offer a seminar exclusively on revocable trust accounts, covering complex scenarios for revocable trust accounts with more than $1,250,000 and 6 or more beneficiaries receiving unequal interests. On the right side of the slide, you will see the other seminar, which the FDIC is offering in 2016, which is called Fundamentals of Deposit Insurance Coverage. This seminar will discuss the 9 most common deposit insurance ownership categories. The FDIC's website, located at www.fdic.gov, is an excellent resource for bankers as well as any depositor or other interested party who is looking for information about FDIC deposit insurance coverage. The FDIC is constantly updating this website with current deposit insurance information whenever there is a statutory or regulatory change affecting deposit insurance coverage. Among the resources most accessed is the FDIC's Electronic Deposit Insurance Estimator, or ED. This is an excellent tool to help calculate a depositor's insurance coverage based on either existing accounts in a bank or to check the amount of potential deposit insurance coverage that may be available based on a hypothetical scenario. In addition, the FDIC has written a number of deposit insurance guides available both online as well as hard copy. These include Your Insured Deposits, which is also available in a large print version. These brochures and other resources are available on FDIC's Deposit Insurance Coverage webpage. If you are interested in ordering deposit insurance materials, including our brochures, videos, or FDIC signage, please go to the link provided on this slide and visit the FDIC's online product catalog. These materials are all available free of charge. Finally, the most important resource is the FDIC's toll-free number. If you have any questions about deposit insurance coverage, please call the FDIC at 1-877-ASK-FDIC or 1-877-275-3342. This concludes our presentation. I want to thank you for participating.